Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Before we dive in, if you want the news that moves markets delivered in real time, 24 hours a day, check out LiveSquawk. It's our audio squawk service trusted by serious traders worldwide. Start your free trial today at livesquawk.com. No credit card required.
Hello and welcome to LiveSquawk's Market Talk, our weekly review. It comes to you on Friday, the 8th of May, 2026. For those new to the podcast, this is our weekly briefing aiming to break down the key stories from the past 7 days and explore the subsequent implications for the markets. We'll also look ahead to what's coming, giving you a heads up on the events and data points to watch out for next week. I say we because every week I'll be joined by a market expert in their field. And today I'm gratefully joined by Beat Nussbaumer, founder and CEO of MacroBeat, FX macro trader, researcher and FX tutor, and a professional that's been around for nearly 40 years in the markets. Before I bring Beat in, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. And with that, I'd like to welcome my guest, Pete. How are you doing?
Hey Harry, not too bad. Thanks a lot. Thanks for having me. And looking forward to trying to make sense of what's happening out there.
It's getting harder and harder, it seems, at times.
Yeah.
We're going to give it a crack. It's not been the busiest week for data, but obviously events have rolled on. We're still in a tentative ceasefire, or tentative in the most exaggerated term when it comes to ceasefire, the word ceasefire. But we are essentially still in a ceasefire as of today. And the market seemed a little bit more sanguine, I think, at the moment, or happy to believe that US and Iran will come together and find some sort of solution at some point. There are practical ramifications at the moment, really, for this shut-in that we've got at the moment and this blockade of the Strait of Hormuz, and we'll come to that in a minute. But also, in terms of data today, we have had non-farm payroll, the monthly US employment report. For those who may have missed it then, just to go over some of the head numbers, then we saw headline non-farm payroll coming at 115,000. That's versus 65,000 expected, and 185,000 in March, which was revised from 178,000 initially. And this marks the first back-to-back monthly gain in non-farm payroll since May of last year. We saw the 2-month average change in headline up 150,000. That's the highest it's been since December of 2024. 2-month net revisions fell by 16,000 versus a fall of 7,000 prior. 2-month net revisions came in negative in 14 of the last 16 months. Private payrolls then rose by 123,000 versus 190 seen previously and 75,000 forecast. Manufacturing fell by 2,000 versus a gain of 15,000 last time out. The unemployment rate came in at 4.337 unrounded versus 4.256 prior, and participation rate fell slightly by 0.1 of a percentage point to 61.8%, the lowest since October 2021. Wages were a disappointment. They saw a rise of 0.2 from 0.3% expected on the month over month and 0.2% prior. The year over year rose to 3.6. That was up 0.2 from last month, but well below the 3.8% many were forecasting before the data release. So we'll start there with non-farm payroll. What was the initial reaction in the markets, or maybe on the dollar, Pete? And what was your initial thoughts of what we saw today?
Yeah, to be honest, I think given the sort of key focus is still on whatever happens with this sort of peace or no peace or escalation or de-escalation or whatever we're talking about. So Hormuz is obviously still the main story. So I think the market probably, even though we beat expectations, I think as usual, even though we have a really weak, usually weak correlation between the ADP and non-farm payrolls, you just never, you always see that the market actually secretly expect a little bit a better number because ADP was better and so on and so forth. But it almost feels the number just had to be out of the way. Interestingly, the dollar did not react at all to the better number. Actually, the opposite. We're kind of leaking right now. It's almost if, dare I say, people expect a little visit from the Bank of Japan before the day ends, given Besant is in Tokyo Monday, but we might brush up on that one later.
Yeah.
Or if there's a taco incoming on some level, which we may talk more about this as well. So I think the market just struggles to fully focus on macro. I would say if we were to get this MOU done and a 30-day pause to negotiate and this and that, maybe the market starts slowly to come back on macro data. Right now, it just seems there's just too many moving parts. I think the market is getting a bit tired of these constant flip-flops on the narrative.
There's a level of fatigue, isn't there?
Yeah, it is. And I think we've spoken in some of the previous sessions when we talked together that, it's the same on my end. It's just you do a lot more short-term trading because that's kind of, it's, I don't really want to use the word easier, but it is just to sort of trade what you see sort of flip-flops. Whenever the market is too optimistic, you can be sure there's something happening and vice versa. And that seems to work. And we just do not get out of this kind of event. And truth be told, if you really look what happened since the war started, we had volatility in the equity market, in the bond market, but FX has been actually quite dull. So there wasn't a lot happening in FX. So it makes it even more probably clear that, yes, we keep an eye on this BOJ thing to understand what the plan is. And the rest, I think the market just doesn't want to preempt because we haven't moved a lot. Like Euro was 118, give or take, when the war started. So we kind of came back to the more or less the entry point. So I think the market is just reluctant right now, at least on the FX side.
Yeah, fair play. We've had some serious volatility anyway in the past few weeks. I want to talk about that in a minute, and we will come to the Gulf situation because I want to leave it to the end because it will then bleed into what we're looking at next week and the subject matter and the data are out next week. I want to turn to UK local elections. On Thursday, we had elections in, I think, some 136 separate councils in the UK. And it's been a very, very poor night for the incumbent government, the Labour Party. They're down, I think, of all the seats they contested, they've only won a fifth of those, if my calculations are correct. And it's looking like a very, very good day for reform. The Populist Party, can we still call them populists if they're becoming the mainstream? But the Populist Party, Reform, led by Nigel Farage, great friend of President Trump. His party have done really well. Some call it a protest vote. I don't know if we can still label it that as well. Lots of connotations really around the UK political scene. What's that done for sterling? Has that also been quiet? Because we pretty much knew that Labour were going to get a bit of a trumping and a bit of a beating today.
Yeah, to be honest, definitely the market has been, a little bit short on the pound, but I think we always knew, like in the past, local elections, nobody really cares. This was just the first time that people did care because it's obviously first message to the government. So in that sense, it's obviously important. But I think the key, what we have to look at, maybe the reaction is coming rather next week. Starmer now said that he takes full responsibility, obviously without resigning. So that means he will probably start to do some reshuffle of the cabinet. Now, last week, whether real or not real, I don't know.
This is the cabinet that's the problem, is it?
Yeah. So there had been some rumors about Reeves going to be thrown under the bus, but there was some chatter back then about Rayner to take over. as in Starmer is so desperate to keep his position that he, everyone who sort of tried to topple him, he just gives him a job. Now, if you were to see, I still can't believe it myself, but if we were to see, not that I like Reeves, but if Reeves would be exchanged for Rayner, then then the bond market won't like it and Sterling won't like it. So I think we focus on a reshuffle of who is he going to kick out, who are the scapegoats in this whole process. He obviously tries to stay on unless he suddenly out of the blue loses that support. But who is going to be out, who is going to come in to replace it? Like we said, the way he fought his Mendelssohn drama just shows how much he's prepared to do in order to stay in power. So that's probably the biggest risk. And so I don't expect him to go. I expect a change of staff in some level.
Yeah.
And I think that could be the key, the credibility for the market. So I think this is all about gilts. And then the knock on to sterling if the investors just start to really doubt that the government got the message.
Okay.
So I think it's a reaction, not post-election. We knew that, so we exactly got what we expected to get. But I think what the conclusion is out of it for the government, I think that's going to be the key.
Yeah, I mean, we've still got obviously a few years to general election, but at the moment, I mean, reform, which are coming from a zero base, really have taken a number of council seats across the UK. You've got Lib Dems have benefited today. Tories, again, they're very quickly sinking here alongside Labour at the moment. Do you see, and a more general question, do you see us turning into the new Italy? And I mean, moving forward, a more coalition-based political order where we're not looking at one overriding majority from a party, and that we will start to have to see parties work together.
Yeah, to be honest, I think more and more, I think this sort of two-party system is getting shredded, especially now with reform in. I don't think the Tories at some point will recover somewhat. Obviously, a lot of people are fed up with politics anyway. So we see that sort of drift to the Greens and maybe in some areas to the Independents. So yes, I think at some point we're going to see what Europe's going to see. Maybe not, in that high numbers that we get so many different sort of multi-party system. But I wouldn't be surprised that we start to see that of national level as well. That there's just no majority, because to be honest, we had this majority for the Tories, didn't really do anything. We have a super majority for Labour. We see what's happening. People are just fed up, and I think that's where the spread from the electoral is going to go. And at the end, we're going to see probably more a multi-party consensus politics, which maybe, to be honest, it's not the worst. Actually, can't be worse than now. And we see Harry. You see that?
Yeah, sorry, I was going to say it's coalition. We saw what he did to Italy back in the day at its worst, and it's not a great look, is it?
Yeah, no, it's not. So to be honest, I think something just has to give. That's the problem. I think everyone sees that right now the way things are going. It's just it's just bad on every corner. I mean, we just don't get anything done anymore. And the question is really, where do we go from here? So,
yeah.
But like I said, the good old general election is still too far away.
Fair enough. If we go back then, and we want to look, we can now focus a bit more, I guess, on the current tensions that we're seeing at the moment in the Middle East. And I've asked you this so many times, and I ask a lot of my guests this. When also just before that, just to quickly go, we did see Norway and Sweden rate decisions. Norway was a bit of a surprise, I guess. Just going through that, Norway raised its policy rate by 25 basis points to 4.25% at the May meeting, and it was pretty much against the consensus, I would say, although some were calling for a rate hike. Nomura said they did note that the decision was very close call. Guidance highlighted that a further rise in policy rate may occur this year. And Nomura, the bank, believes the main reason Norges Bank raised its policy rate is that it has lost patience with sticky underlying inflation. Did you look at that as an event? Did you pay much attention to the NOK?
Yeah, to be honest, I mean, I think there was 14 basis points price for Norway going in. So
yeah,
while I agree the consensus was definitely for no hike, the market obviously did think otherwise. The market did see some risk that this could happen. That's why probably the reaction in the FX market was a bit limited. We had a quick drop of nearly 1% in the crosses, Norway versus Sweden. Obviously, first we tried to rally on the back of the Riksbank leaving rates unchanged versus rate hikes in Norway. But Norway versus Sweden, the problem is it's again, we have to talk about the war, or actually the peace. Norway has obviously been bought a lot, especially against Swedish krona in the last 60 days of the war, with as an oil correlation trade. And so the market was quite happy to fade any NOK strengths after the rate hike, because short Norway versus Sweden seems to be I use it again, the easier trade than trying to double guess other risk pairs if that MOU works, or if the peace works and the oil price is really coming back off. So that's a 3 to 5% potential trade. So that's why I think the market was so quick fading that rate hike story. And, the market will have time to watch the oil price until the next Norges Bank meeting. So the next hike is not yet really on people's mind. It's really more the positioning as the oil trade rather than actually a Norges Bank trade.
Awesome. Again, and that does now neatly bring us on to, in terms of oil, this tentative ceasefire. Do you think we've discounted most of the scenarios that are out there at the moment? I mean, we're going back and forth on this thing.
Yeah.
We've had even today. There's been talk of explosions near Dubai and explosions in the Strait itself, where ships have been. There was the last report, as of recording, 3 tankers have been hit by US forces, empty Iranian tankers, which suggests to me that if they're willing to run the risk and run the gamut of trying to get their tankers through the Strait back towards Iran, that they're starting to run out of storage for their oil at the moment. That's just a speculative point by me. But just in the wider context, what are your views in terms of what you've seen this week, the backwards and forwards, and just from a trader's perspective, what are you doing to help contain some of that risk?
Yeah. To be honest, on the broader picture, we can clearly see, or I feel that way anyway, that Trump wants an off-ramp. He wants out. And so, we melted it down to a 1-page memorandum of understanding, which is quite astonishing, having just gone through 60 days of war, and then kicked the can down the road. Because to be honest, I think the last nuclear deal took I don't know, a year and a half, can't remember exactly, but it's not something that happens around the corner, because that's a lot of technical talk involved. But Trump seems to be willing to kick the can down the road to sort of, be this sort of freedom guy. And so the market seems, we see a little bit risk off, like yesterday afternoon, early evening, when all these things happened again, the little fight that broke out in the Strait of Hormuz. But as soon as it goes quiet, the market is just back on this glass half full story, especially with Trump commenting, ceasefire is still intact, going back to fighting. So the way it feels is the market is definitely pricing we're not going back to bombs. Hormuz is obviously the issue that we will talk a lot about still, the global economy impact for the longer the strait is closed, and so on and so forth. And that's why it was a bit surprising that this Project Freedom was canned after 48 hours, because I think Saudi Arabia actually wasn't consulted and just asked the US to stop. Not rejecting it outright. But the US is coming with all these major things that involves a lot of other countries, and they don't bother to speak to those countries. It's a bit of a problem. But as a sort of a broader picture, it looks like we are just limping towards something that the war does not restart. But I think this back and forth is going to continue. As we see, there's different factions in Iran. The Revolutionary Guard has none of it, and they just start to enjoy that they're actually at the choke point there in Hormuz and how much power they actually have. So Trump is probably forced to sign a worse deal than he ripped up in 2018. That's basically what I think is going to happen, because sooner or later Trump has to go away out of the Gulf. He just has to. And
well, yeah, like you say, I think he wants to. But I mean, what's scary for me in amongst all this is that you've got the UAE and Saudi restricting US use of bases in those particular countries. So,
yeah.
Like you say, he's starting to alienate even some of the allies in the region that that he will probably normally depend upon, and that to me says that in one way, shape, or form that we could be nearer the end than the beginning if he's now losing the buy-in from those needed allies in the region because they're, for whatever reason, they're sick of this dragging on.
Yeah, because realities. I mean, it's like we said. It's Iran is. Whoever studied Iran of the last 47 years for every conflict that we had, it's just astonishing to see that the US has been surprised about a few things, or maybe it's just him, maybe it's just, I'm sure his generals told him all about it, that the fact is Iran can just sit out a while longer. The only risk Iran would sort of have over time is because the free fall of the economy and their currency, that at some point you may again face internal pressure where people just have no other way than to take back onto the streets. So then you have like this sort of late effect of almost an attempt of a regime change by the people, which should actually have happened in February, not in May or in June. So it's I think the noise is going to here to stay. We might just have to always stay out of the noise a little bit. The market is still keen to sell the dollar once things start to quiet down and the oil price starts to come back down. Maybe that dollar selling idea is not as strong as it's been before, because the market has noted that the US economy is just still quite strong. And suddenly we have like the ECB talking about rate hikes in June, which is obviously, the wrong thing to do, the same as they did wrong in 2008, to kind of react against just a knee-jerk reaction to the oil price, so suddenly we have a complete new picture that we wouldn't have had in January. In January and February, we talked about rate cuts in the Fed and in many places, and suddenly we're talking rate hikes. And I think the Fed is going to sit out. The ECB might hike, but it's not going to support the euro a lot, because I think the people just looking straight through that it's the wrong policy. And that brings me to the UK, similar there. And Bailey seems to be trying to hang in there, but I think the UK and the pound will eventually be the main target for the stagflation trade, because our growth is just generally too weak. So I think we have a bumpy road. We haven't mentioned the BOJ yet, that has intervened twice now in dollar yen to the tune of about $55 billion.
On the scale of things, but you've watched these markets a long while, and you're very familiar with the way the Japanese finance ministry works and the BOJ works, and how the yen influences plays. Where is this in the scheme of things in terms of intervention? Is it fairly light touched at the moment, and do you expect more to come?
To be honest, I mean, well, they have to. If they're really serious, I mean, so far for the sort of $55 billion, I would say they have not yet broken the neck of the market. I don't think they have been that forceful just yet, because in the past, like in 2024, they had, there was always either, weak data in the US or dovish Fed. So they always had a bit of help to intervene when the dollar was already on the way down. Now, the disadvantage right now has been that the oil price shot up and the market sold a lot of yen because of that. And we go back to the 160 that they really want to defend. So they're clearly don't want to have dollar yen above 160. I still believe they're going to come back. It's very interesting that Bessent is going to be in Tokyo on Monday. They will be talking about the weak yen. He said that. Whether or not they intervene a little bit beforehand, the dollar yen is a bit lower by the time Bessent walks into the office. I don't know. But I expect something from there. So I think that as long as, let's put it this way, as long as the war doesn't break out again and oil goes to, I don't know, $150 or higher, I think we've seen the highs in dollar yen. And the BOJ has no interest to push it to 140. They don't want to have yen, like too big of a yen strength too quickly. But it's clearly the FX has played a negative role in their entire inflation forecast, and so they have to watch not to get more weakness. The interest from Bessent is not just on the yen, obviously, or the strong dollar. It's the sell-offs we've seen this year in JGBs, or at times like JGBs falling off a cliff, that started to affect long-term rates across the world. And I think this is, if you remember back when we had the Fed checking rate story in dollar yen, that was said to be came from the US. And that was the time when JGB started to affect the long end in the US. And that is something Bessent just doesn't need to have. And so not sure what kind of cooperation they do, what kind of plan they talk about. I can't see really the Treasury or the Fed or the Treasury telling the Fed to start dollar yen at this point. But there be something which they have to kind of do, because I think the US also needs a more stable dollar yen, or even a lower dollar yen, really, to kind of just quiet down this whole fixed income side of things. So it's a bit more complicated, but I expect the BOJ to be back in. I expect them to limit dollar yen at 160, may come what will. And if they have to intervene more than they did in 2024, so they will, because end of the day, like you rightly say, I'm watching them for over 40 years, and they buy low and they sell high. That's just what they do. And people, always laugh, oh yeah, they're not successful. At the end, they're going to be successful. That's just, how it's going to be, because they can do what they need to do in order to control it, at least on some level.
But I mean, ultimately, for the Japanese authorities, the weakness in the yen is no longer economically or politically acceptable for them.
Correct. And I think this is probably a new angle, which the market probably. I think the key to this is a little bit deeper, and I was a little bit shocked. I think last week it was when I saw some charts from some of the life insurers in Japan that actually were net sellers of JGBs, because they have some funny rule about mark to market, which is totally insane if you talk about your own government bonds. So because the theory, if you remember back end of last year, we talked about this potential change in the carry trade on a level where the Japanese now have high enough yields in the 20, 30, 40-year space that they no longer have to go abroad. Not meaning that they already sell every long bond in the world, but new investment is going to happen more in Japan, and over time you're going to see the repatriation, and this big yen funding trade is at the end. Now what happened is that actually some of these life insurers were net seller of JGBs, and so that would, if I would have a suggestion to Bessent, that's exactly what I would talk to the Japanese. It just cannot be that your own investors, be it pension funds, whatever, have to have mark to market for your local government bond as if it were a risky trade, right? So you have to sort of think that as a Japanese institution, that JGBs, it's like run to maturity, like the sort of things we had in the US at the time.
Sure.
And when that happens, then that will be the signal for the yen. So that means what I try to say with this is just the trade should be clear that the yen should definitely start to strengthen, but because of this kind of Japanese not yet buying JGBs is kind of just a heck of a delay, and then came the war, and then came the oil price, and then came the change in government in Japan, and a little bit of a fiscal worry. So there's a few things to sort out here, but I think 160 the high, they will defend that, may come as will, and I think dollar yen. And I think that's probably the easier dollar to sell into the rallies right now, because you have BOJ on your side, if you know what I mean.
Yeah, that makes sense. Makes sense. I want to move on. We're coming to the end of the episode, so I want to sort of crack on with the week ahead. And again, we were going back to the price and everything else. With US CPI data out next week, which will be the headline reading for April. Obviously, a lot of interest in that, but I think there's going to be just as much interest in PPI. I remember Ryan, one of our other guests, has said we should start looking at pipeline inflation a bit more closely now, because of the connotations it will have on headline inflation. There's a note also from Deutsche Bank that said, bigger picture, markets have retained a remarkable faith in longer term inflation staying anchored around target. That's despite another energy shock, several years of above target inflation by now, and a persistent upward bias historically as well. Do you think that's, I mean, longer term 3-year inflation expectations have remained relatively stable? I know the Fed looks at that. Is this all a little bit of noise at the moment because of where we're at with the Middle East and everything? We want to start looking more at expectations than we do at actual prints at the moment.
Yeah, to be honest, especially when it comes to the US, I think the Fed is definitely. I think the Fed still gets also that little bit of wash bonus, in a sense that, yeah, we all know he's not going to come in and cut rates just because he got the job, because he told Trump he's going to cut rates. We know that. But I think on the wars, we're definitely going to have a period. And I think that is probably shared by maybe a majority of FOMC members, that right now, best is just, I think we're on a long pause. So I think, as you said, I think in the US market, people might be more willing to focus on the inflation expectation rather than the hard prints. Yeah, we get an hour of fun or 2 hours of fun, fine. But in essence, I cannot see the market move very far from center on these prints unless they're totally crazy. But I think in the US, we are probably more willing to look through it. I think Europe is more nervous on this, so is the UK. But I think the US is going to be a little bit cooler. So I'm not expecting much from the US data, CPI or PPI print, other than, like I said, an hour or 2 of fun post data.
Yeah, I think there is a consensus around 3.7 for the year-over-year figure, which obviously is elevated. But again, people look at this and the core reading expected to remain roughly up a tenth, 2.7 for the year-over-year core. That will take it up a tenth from 2.6 last time out. We also have China CPI out next week. US retail sales data to see how solid, sturdy the US household consumption is at the moment, which is held up pretty well of late. But again, if we start getting slightly higher inflation expectations, slightly higher inflation prints through, will that start to deter, or would it, wages have started to look a little bit more mixed maybe, and that potentially could be what we see damage retail sales and consumption stateside. We have a second reading of US Q1 GDP as well to look out for. A bit more detail in that report next week to pay attention to, so we'll keep an eye out for that. In terms of what we're looking at for that second read, let me just get my numbers up if I have them. I don't, for some reason. Sorry, it was Eurozone second read, not the US. My apologies. So you got Eurozone second look at Q1 GDP. So that's looking at 0.8%, I think, on the year-over-year, 0.1% quarter-over-quarter. So that's the European. We have UK GDP though. That is, we do have that out next week for sure. And we've talked about the flash reading. We're looking at HSBC are looking at a 0.5% quarter-over-quarter, 0.9% annual read for Q1. Slightly better than expected Q1 figure, really. But I think based on the back end of Feb, I think deterioration probably comes in the March reading as well, Pete. But from here, we tend to see it tail off. I think seasonally we tend to have a good first half of the year for UK numbers, and then that tends to back off in the second half of the year, doesn't it?
Yeah. Yes, to be honest, I think the UK one is the one definitely I'm interested one, just in this whole story of the UK and the possibility of, like I said, once we are able to move a little bit past the war or the peace or whatever we get, I think we might actually start to think about which countries are, or which currencies are the ones where we might get real stagflation, not just stagflationary data, but actually, and for me, like I said, the UK with its kind of limping around is just probably one of those where we could see a problem. I mean, like you said, we got a bit stronger data the last time, but if I see what's happening here, I just find it very hard to believe that we're going anywhere, because all we hear is the other side of businesses going under, people spending less, all the problems that we have. It's just very hard to see that there is any growth in the UK. I wouldn't know where it's coming from. And so I really think that sterling might have an issue towards the mid part of the year, later part of the year. And that's where I sort of focus, because I think the dollar is going to be complicated soon. Not, very soon we suddenly start to talk about midterm election in the US and God knows what. So I think I see the value this year maybe more in these sort of niche areas where we have to focus on currency versus currency rather than just always just the dollar, and see what the market is willing to sort of trade. And I think stagflation for me is definitely one topic, especially with all these price pressures that we see out there, and growth pressure on the opposite side. I mean, every central bank says the same: upside risk on inflation, downside risk on growth. And so that means there are countries that are just a little bit on the edge on the growth side, and I think one of them is the UK.
No, fair enough. We have to finish it there because we're just coming to the end of the episode now. Anyone who wants to look at what's out next week, wants to listen and take in the data, please visit livesquawk.com, take out a trial of the service, see if it's something that can help your trading day and investment as an investor as well. Also, we have we'll put this episode up on our platform, on our social media platforms, as well as on the podcast platforms. I'd like to thank Beat Nussbaumer. Thank you very much for your input today. Thanks very much, Harry, for having me. As always, a real pleasure. And I can only say LiveSquawk is my go-to squawk box out there. So whoever is listening, give the guys a shot. They are fantastic. Very kind. You can also find research from Beat at his Macro Beat. Go to his site, FX Macro Trader Research and FX Tutor as well. So go there to the Macro Beat and find more insights from the man himself. Listen, thank you very much, everyone. We'll be keenly looking at the weekend to see if any kind of resolution can be found in the Gulf, but we'll keep an eye out anyway, and we'll be back next week for another episode. But have a safe weekend, enjoy it, and we'll see you on the other side. Thanks so much. Same to you. Thanks a lot, Harry. Cheers.
LiveSquawk keeps serious market participants ahead of the news around the clock. Start your free trial at livesquawk.com.
Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.